Welcome to the video, everybody. Anthony here with Hawkeye Traders. Hope everyone's having a wonderful day. Want to recap calling the low on the S&P 500. And before you chop my head off, I didn't call the exact low, but I did call the low that we would not settle below or violate below in order to see a strong reversal transpire. Now, I want to talk about that. I want to dissect the price action. I want to dissect the volume and really kind of work our way into this because this is super, super important, all right? Sometimes we're going to just create this reversal and never look back. Other times it's going to be retested and sometimes even violated, right? The market is unpredictable to a degree and very predictable to another degree, okay? I, with great confidence, said this morning live in front of other traders, so this is not hindsight, this is not looking back, this is not cherry picking, this is me in the live market with other people who are trading live money, and I said, hey guys, look, I think that we need to watch this area very carefully because if this area holds as a low for at least a period of time, there's a chance that we could push higher, right? Because the reality is, guys, the market dynamic can change instantaneously, quicker than you and I could ever even fathom. But the reality also is that there are isolated areas where volume and price action interact, where these can be found, identified, and also used to your benefit, right? I mean, because at the end of the day, the market functions around two things: volume, price action. Those are the two things that the market functions around. If your trade plan is not volume, price action forward, you're probably finding out that you're having very inconsistent results. Maybe certain market conditions are providing you with opportunities that are working and perhaps others are not, okay? So it really comes down to the raw analysis of volume and price action. As you can see, I will hide the drawings on my chart. That's all that's on my chart, right? We have Hawkeye volume on the bottom, the volume radar dots. We have the price action that has the volume paint bar and the wide bar, which are these magenta purple bars that are printing. Okay, so that's what we're going to dive into. I'm going to put my drawings back on. As you can see, I was just simply identifying the area where I believe the reversal had occurred. So let's zoom in on this. Let's take a little deeper dive here into this price action. This is the S&P 500. This is a 3-minute chart, meaning each candle represents 3 minutes of price action. So with that being said, of course we get the opening bell at 9:30. You can see ultra high volume came into play there. But what I was focused on was the 9 o'clock candle. Okay, this candle very specifically printed very high selling volume. If I discount the opening bell, you can see just how substantial that candle becomes. In fact, the highest traded volume from the Globex open, right? Now, it looks minuscule when I start looking at the US Open volume, right? But keep in mind, this was identified live. This was not identified in hindsight, which put in perspective that the 9 o'clock volume was extraordinarily high based on all the volume previously offered from the prior night open. So I see this, I'm like, all right, look, we're making a brand new low on the session, right? Into yesterday's low, very significant, right? So you can see we had really strong rejection there. That was the low of yesterday's session right here. I'm going to drop a line on it just so you guys can see exactly what I'm always looking at. Okay, so I'm going to drop a line right there. That's yesterday's low, prior day low, PDL for those of you who are not familiar. We push into the PDL, or the prior day low, on extraordinarily high selling volume with a wide bar, and we probably close roughly the 60-65% area of the overall width of the bar itself, okay? So keeping that in perspective, what does that draw my attention to? Ultra high selling volume into yesterday's low and zero follow through, at least initially, right? The market immediately reverses. We come back up, we push back down, but I want you to understand that we never settle below that low. It's very important that when these wide bars occur on ultra high volume, that you are looking at the highs and the lows of that candle, because they're going to, more often than not, be very telling about what is about to happen next. So you can see the market rebounds, comes back up to this last little area that it fell from. We push right back in. 9:30, U.S. Open hits, right? That's the opening bell. You could see immediately huge surge of buying volume comes in off of the PDL, prior day low. Okay, so we get rejection of sellers, we get huge buying volume. Guys, that's like checking two major boxes here, saying we're probably going to push higher. Okay, push higher to where, right? I mean, for me, I'm always looking at kind of immediate highs right here. I'm like, all right, can I get price to retrace back to these immediate highs, 53.34, and then I just simply look back and I'm like, oh wait, the session high is right here. Can I get to 33.35? And then I go, all right, I got some highs over here. Can I take more profit here? Then I got a little low here. Can I push there? And then I got more highs here, and so on and so forth. By looking left, guys, notice we went from the PDL to the PDH, the prior day high. We fell a few ticks from just testing this high. In fact, you can see we grabbed a little liquidity there. This was the initial high placed. We pushed down, came back up, grabbed whatever orders were sitting there, and then we started moving our way back lower. And wouldn't you know, we fell just a tick or so from the prior day high. How can I navigate these things? Well, I can navigate them with a great deal of confidence by simply employing basic price action, which the Hawkeye Mastery class will teach you, and of course the Hawkeye volume. What does the Hawkeye volume consist of? The volume itself, as it prints on the bottom here, the volume radar dot, the volume paint bar, and the wide bar. This is all you need. Again, if I just take all my drawings off, you can see all that you need is already there. It's a relationship between volume and price action, which ultimately sets the stage for what's going to happen next. Okay? Again, you need a conservative, well-built, risk-forward trade plan, right? And once you have that, now you can say, all right, I'm going to implement volume and price action. Before I implement anything else, the primary focus of what I'm looking at for the opportunity that meets my edge or my trade plan is volume and price action. And frankly, guys, it should be yours as well. Okay? I say this with 13 years experience. I have tried every indicator and trading software under the sun. If it is not volume and price action forward, you are missing the foundational picture of what builds a replicable trade plan that you can repeat over and over and over again. And that edge is what provides your ability to become successful in the business of probability. Trading is a business of probability. So when I see volume and price action act in a certain manner, like I did this morning, live at 9 a.m. Eastern Standard Time, I identified this low and said, hey, if we can't push through this low, we reverse here. And guess what happened? We reversed here. And I'm going to tell you how much we reversed from this low. Let's call it 90 ticks, just to be fair. 90 ticks on the S&P 500 from that reversal to the high. 90 ticks times $12.50 per tick is $1,125 per contract from start to finish. Now, of course, I always recommend every good trade plan should have the ability to pay and protect yourself. Meaning, as you start to come into these prior highs here, you should be taking some profit off. But the beauty of when there is a volume reversal is this. More often than not, price never comes back to this level. You can see we had an initial retest on the opening bell. That happens. But once that strong buying came in, to confirm this, you can see that we never revisit this area through the balance of the entire session. So guys, I shoot these videos every day because I want you to understand, if your approach to the market is not first to understand the interaction between volume and price action, you're going to have a hard time building that consistency, right? You may have a strategy or a tool or an indicator or a software that works under certain market conditions. Volume and price action, the interaction between the two of them and understanding it, works during all market conditions, right? And sometimes it works to tell you, hey, you should just stay away from the market at the moment. And that's okay, because that's part of trading as well. So I hope you enjoyed this video. If you learned something, please feel free to leave a like below. Subscribe to the channel if you haven't done so you don't miss the next video. If you have a question, feel free to leave a comment in the comment section. I will reply to it personally. If you'd like to reach out to myself or my Hawkeye Concierge team, the emails are also below this video. And of course, I put a phone number there as well. Guys, all I can tell you is that the understanding and the interaction between volume and price action must come first. Okay? Whatever else you compile on top of that to increase your edge is totally fine. But volume and price action first. Hawkeye takes volume and price action and makes it very easy for you to understand the relationship by providing the paint bar, by providing the volume coloring by who's in control, by providing the radar dot, by providing the wide bar. All these things visually will help you see and understand what's happening more quickly and more efficiently, which gives you more time to simply react. Guys, I appreciate each and every one of you. God bless, and I will see you in the next video.